Is the worst recession ever about to happen? Let's dive in. With economic uncertainties on the rise, it's crucial to understand what might be coming. Experts are divided on whether we're heading for a severe recession this year. Some experts predict a major financial crisis driven by high inflation, rising interest rates, and ongoing geopolitical tensions. One alarming sign is the current inverted yield curve flashing a warning. This could mean a significant financial turmoil if corrective actions aren't taken soon. If a severe recession hits, it could lead to massive job losses, a significant drop in stock markets, and widespread financial instability. Some analysts warn that even a mild recession could trigger a 40% plunge in the stock market, echoing the crash seen during the dot-com bubble. Remember the 2008 financial crisis? It was triggered by the housing market collapse and led to massive bank failures and a global economic downturn. The upcoming recession, some say, could be even worse due to the current high levels of debt and overvalued markets. But don't panic. Staying informed and prepared is key. Diversify your investments, build an emergency fund, and stay updated on economic trends. Stay tuned for unique tips on how to navigate these economic challenges. So, what is a recession anyway? Let's break it down. A recession is a significant decline in economic activity that lasts for months or even years. It's part of the economic cycle. Economists measure recessions by looking at factors like GDP, employment, real income, industrial production, and retail sales. If these indicators decline for a prolonged period, it's a recession. But what causes a recession? Several things. High inflation, rising interest rates, and financial crises are common triggers. For instance, the 1991 recession was due to a banking crisis. Remember the COVID-19 pandemic? It caused a short but severe recession in 2020 because many businesses had to close. During a recession, businesses earn less, unemployment rises, and people spend less. This creates a cycle that can be hard to break, but don't panic. Understanding what a recession is can help you prepare and respond better. Stay tuned for more tips on navigating economic downturns. But what causes a recession? Let's break it down. Understanding the causes can help us prepare and respond better. Recessions can be triggered by multiple factors. High inflation is a big one. When prices rise too fast, people buy less, slowing the economy down. High interest rates can also lead to a recession. They make borrowing expensive, which reduces spending and investment. Loss of consumer confidence is another cause. When people are worried about the economy, they spend less and businesses suffer. Financial crises like the 2000 tech wreck can devastate the economy. When markets crash, investment dries up, and layoffs follow. So high inflation, interest rates, loss of confidence, and financial crises are major triggers for recessions. Stay tuned for more key insights on navigating economic challenges. Why should you be worried about a recession right now? Let's dive in. A recession isn't just an abstract economic term. It can directly impact your life in several ways. First off, job security. During a recession, businesses often cut costs, and that can mean layoffs. You might find yourself or your friends suddenly without a job. Your savings and investments can take a hit too. Stock markets tend to plummet during recessions, which can reduce the value of your 401k or other investment accounts. Then there's the cost of living. Inflation can rise, making everything from groceries to gas more expensive. If wages don't keep up, your purchasing power decreases. High interest rates during a recession can also make borrowing more expensive. If you have loans or credit card debt, you might end up paying more in interest. Look at the COVID-19 recession in 2020, which caused widespread economic hardship, from job losses to financial instability. Bad things can happen quickly. So what can you do? Start by building an emergency fund right now with a high-yield checking account at Capital One 360, reducing unnecessary expenses and staying informed about economic trends. Stay tuned for more great tips on how to protect yourself during economic downturns. How will this upcoming recession be different than others in history? Let's dive in. Every recession has its unique characteristics, and the one we might face soon is no different. First, high interest rates are playing a significant role. The Federal Reserve has been raising rates to combat inflation, making borrowing more expensive for both businesses and consumers. This is a key factor driving the potential recession. Second, global supply chain disruptions continue to affect the economy. Issues like semiconductor shortages and shipping delays are still causing problems, which is different from past recessions where supply chains were more stable. Third, the rapid technological changes and the dominance of tech giants, often referred to as the Magnificent Seven, companies like Apple, Amazon, Amazon and Google, are influencing the market in unprecedented ways. Their performance and market influence could create unique economic dynamics. Fourth, the labor market is tight, with low unemployment rates despite economic concerns. This is unlike previous recessions where high unemployment was a hallmark. However, wage pressures and labor shortages add complexity to the economic outlook. Lastly, geopolitical tensions, such as the ongoing impacts of the Ukraine conflict, are creating additional economic uncertainty. These tensions can affect energy prices and global trade, adding another layer of unpredictability. Understanding these differences can help you better prepare and respond. Stay informed and proactive to navigate the unique challenges of this potential recession. So what was the worst recession in American history? Let's dive in. Understanding the worst recession can give us insights into economic resilience and preparation. The worst recession in American history is widely considered to be the Great Depression. This severe economic downturn lasted from 1929 to 1941. During the Great Depression, the U.S. economy experienced a massive contraction. GDP fell by nearly 30%, and the unemployment rate soared to around 25%. Many Americans lost their jobs, homes, and savings. The Great Depression was triggered by several factors, including the stock market crash of 1929, bank failures, reduced consumer spending, and prolonged drought conditions affecting agriculture. Life during the Great Depression was incredibly tough. Bread lines, soup kitchens, and massive unemployment became common. People struggled to meet basic needs as the economy continued to decline. The government responded with significant interventions. Programs under President Franklin D. Roosevelt's New Deal aimed to provide relief, recovery, and reform. These included Social Security, unemployment insurance, and various public work projects. Comparing the Great Depression to more recent recessions, like the Great Recession of 2007 to 2009, highlights how economic policies and safety nets have evolved to better manage economic downturns. Understanding the Great Depression helps us appreciate the importance of robust economic policies and the resilience of the American economy. But what can you do to protect your family from a recession? Let's dive in. Recessions can be tough, but with the right steps, you can safeguard your family's financial well-being. First, build your savings and start now. Aim for at least 3 to 6 months worth of living expenses. This cushion can help cover unexpected costs if you lose your job or face other financial hardships. Next, create a budget and stick to it. Track your income and expenses to identify areas where you can cut back. This will help you save more and spend wisely. Reduce your debt as much as possible. Pay down high-interest credit cards and loans. This reduces your financial burden and frees up more money for savings. Don't put all your eggs in one basket. Spread your investments across different assets to reduce recession risk. Focus on job security. Work hard to keep your job. Enhance your skills and keep your resume updated. Being adaptable and skilled makes you more valuable to your employer. Communicate with your family. Discuss your financial plans and make sure everyone is on the same page. This can help reduce stress and ensure everyone knows their role in sticking to the budget. Remember, while recessions are challenging, taking proactive steps can make a big difference. Stay prepared and stay positive. How can you adjust your investments to prepare for a recession? Let's dive in. Recessions can be tough on investments, but with the right strategy, you can protect your portfolio. First, diversify your investments. Spread your money across different asset classes like stocks, bonds, cash, and real estate. This helps minimize the risk of all your assets dancing down together in a recession. Consider adding safe haven assets like treasury bonds. These tend to hold their value or even increase when the stock market drops. Look for dividend-paying stocks. Companies that pay dividends often have strong balance sheets and can provide a steady income stream even during economic downturns. Maintain dry powder for rainy days. Keep some of your investments in easily accessible accounts. This gives you the flexibility to cover expenses without selling off long-term investments at a loss. Regularly rebalance your portfolio at least once per year. Adjust your asset allocation to maintain your desired level of risk as market conditions change. Finally, consider consulting with a financial advisor, preferably a CFP. They can provide personalized advice tailored to your specific financial situation. Remember, preparing your investments for a recession is all about balance and strategy. Stay proactive and stay informed. Recessions can have a serious impact on your life, but being prepared can make a big difference. Got questions? Drop them in the comments. If you enjoyed this video, let us know with some comment love. Thanks for watching. Don't forget to like, share, and subscribe for more practical economic insights. Stay informed and let's navigate these uncertain times together. Withdrawal Investing Insights, signing off.